The priority right now has to be on capital preservation, not capital gains.
Thanks for joining us for part 2 of our interview with former US Congressman David Stockman. If you haven't yet watched part 1 of our discussion with David, please head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that David and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to subscribe to this channel by clicking on the red subscribe button below. All right, let's get started watching part 2 of our interview with David Stockman. All right, so David, I want to dig into that because you have, in your storied career, interacted with the Fed and you have been on Congress. It seems very clear that you cast a fair amount of blame on where we are today based upon poor policies that we've followed both on Capitol Hill and at the Fed. I'm curious, are there any, we make you emperor tomorrow, yeah. What reforms do you think are most badly needed right now? Are there any particular policies that you would love to see adopted?
Yes, I would have 3 reforms. First, I would reform the Fed. Then I would reform the Fed again. And then I would do it still a 3rd time. I mean, that is the fundamental problem because it is causing all the other players in the system, the fiscal decision makers, the politicians, when it comes to the budget and the debt and the borrowing and the spending, the Wall Street operators, the C-suites, and what are they doing with their balance sheet and cash flow? Well, they're borrowing money and diverting cash flow to buying back stock and doing stupid M&A deals because that's the shortest route to a higher stock price and a better value for their stock options. So everybody is being misled. Everybody is being given clearly, drastically erroneous price signals by the Fed. And so that's where we start. How do we do that? Well, you can say abolish the Fed, but that's sort of pie in the sky. I would go back to the idea that Carter Glass had when he wrote the legislation way back in 1913. And Carter Glass is, for some reason, loved by the liberals as well as people who really understand the history. And he basically said the Fed is a banker's bank. It is not the GDP manager. It is not, give it a remit to target prices, the inflation rate at 2.000%, or full employment GDP, if anybody can figure out what that is, or in any of the rest of their so-called policy goals or mandates. Get rid of all that. Let them function as a passive source of liquidity by supplying cash against good collateral at the market rate of interest plus a premium or penalty for going to the Fed, and get out of the day-to-day Wall Street, get out of monetizing the government debt. That sounds pretty simple, but it would be a earth-shattering change, and it might finally allow true, honest price discovery to come back to the financial system, and might allow what is now a secondary market casino to be, returned to its original role as a place to raise and capital and allocate it to the highest and best use. So that's what we need to do. I think a lot of the other things, like too much waste of corporate resources and stock buybacks would end. I think we would get back to a more prudent fiscal mentality on Capitol Hill because it was there. When I was a congressman in the 70s or in the OMB in the 80s, these people really were afraid of deficits because historically they knew that if they got too big, and in those days the Fed didn't monetize massively like it does today, well, then there would be crowding out, rates would go up, they would hear from their car dealers, they would hear from their small businessmen that, you're killing us, get the budget under control. That, all of that's been lost. And so, everybody's been cast adrift to make really bad decisions. And it all stems, from the tremendous mistakes being made by the central bank. So that's the reform. The rest of it is minor, really. The rest of it is minor. You have got to get to the central bank, and you got to get them out of the active macro management of the financial system, the economy, putting puts under the stock market, and all the rest of it.
All right. So the worst of the root cause issues here stem from the headwaters of the Fed, is what I'm hearing you say. Let me ask you this again, because you have an insider's view that few do. It is where the Fed is today, where it's positioned, the policies that it's pursuing, the decisions that it's making. What do you think is the leading cause? Is it incompetence? Is it evil, meaning that the Fed is captured and doing this for special interests? Or is it the Fed is stuck, that they've just gotten themselves into this corner and the problem has metastasized so large that they can't do anything but what they're doing in the short term, because anything else would just crash the system?
Well, anything else probably would crash the system, but I think it's more, I don't think it's evil. I don't think it's, malevolence in some sense. I think it's groupthink that has gotten so narrow, so stifling, that they no longer remember what the debates used to be about in 1992 or 1980 or 1968. There is a recency bias that is so strong that, that they've basically forgotten history. You look at what the minutes say every month when they come out, or what, the chairman jabbers about when he does his pressers. It's all about movements in the last couple days or weeks or months. So I think they basically have painted themselves into a deep corner, and the deeper they've gotten into that corner, the more stifling the groupthink has become. And now they don't even recognize how crazy it is to have the stock market where it is today, and they're still buying hand over fist $120 billion worth of debt a month.
All right. Well, great, David. And I could go on with you like this all day. And sadly, I can't. So as we begin to wrap things up here, let me ask you a question that's on the mind of, I think, every viewer watching this program, which is, all right, given all of the risks and concerns that you've raised here, your very strongly worded prediction that at some point the chickens are going to come home to roost, and the Fed is not going to be able to continue kicking the can down the road, and both economically and in the markets, there's going to be a fairly serious reckoning, maybe even more than a fairly serious reckoning. What advice do you have for today's concerned investor who's looking to protect their wealth and try to prudently grow it, but they don't want to become collateral damage to the correction that you're talking about?
Well, look, I'm not an investment advisor, so I wouldn't pretend to tell people exactly what to do. But if you look at the big picture, the era that we're in, which is much different than, say, it was 20 years ago or certainly 40 years ago, the priority right now has to be on capital preservation, not capital gains. The priority right now has to be on liquidity and not, swinging for the fences. The priority right now has to be total distrust of Wall Street, because almost everything that trades there has been infected and contaminated by this massive, central bank and fiscal stimulus. And so therefore, none of the values are real. A 10-year treasury bond, even at today's yield, I guess was 160, is way under what it should be yield in a world that has inflation and where you're putting your money up for 10 years. The stock market is ludicrous. I was talking about the Russell 2000. It's trading at 45 times next year's income. And next year's income is supposedly going to be up, or net income of the Russell 2000 companies, by 45%. So you put those two together, and you shouldn't be touching it with a 10-foot pole. So I know it's hard for people to say, there's no way that I can make 5% or 10% or certainly 100%. I don't think those options are here right now. It's way too dangerous. This situation has now gotten to the point where something's going to give, and when it gives, it's going to be big. It will be violent. I mean, the Dow could go down thousands of points in a very few days if the unraveling starts, and then there'll be no place to hide. My best advice is this old saying, some of you have probably heard it, about what happens when the cops raid the house of ill repute. Well, the answer is they carry out the good girls, the bad girls, and the piano player too. And so the point is, the house of ill repute is about ready to be raided. And you don't want to be caught in there with practically anything that you could buy today, because it won't have a good ending.
All right. Well, look, you didn't mince words there at all. So thank you for that. And it's really interesting because that is so contrary to what so many people who are long today's market that's not the narrative that they're playing against. So if indeed your predictions come true, David, sadly, I think it's going to catch an awful lot of people by surprise. Anyways, David, like I said, I could have gone all day with you. I would like to pick this up again at some point in the near future. Hopefully we can have you back on the program again at some point in 2021.
Okay, sure, we'll do that.
All right. Well, David, as always, such a pleasure. Where can people who want to learn more about you and follow you and your work find you?
Well, I write about these things every day. I have a lot of charts and graphs and data. It's not just opinion and philosophy. My publication is called David Stockman's Contra Corner. It's a subscription service. It's $1 a day, so it's a heck of a bargain. And you just Google it, and you can sign up pretty easily. And we'd love to have more subscribers.
Excellent, David. And if you're watching, definitely go to David's website. It's one of the sites I read daily. It is a chart festapalooza and just insight packed. David, thanks so much again. And again, love to have you back on the program sometime soon. We'll
do that. Thank you.
All right, and as we do every week, we will recount some of the highlights there with David, with the lead partners of New Harbor Financial, as well as talk about what the markets have done since last week's video. John and Mike, yet another week, yet another great guest, former Congressman and financier David Stockman. Boy, like a lot of our recent past guests, a lot of what he said, particularly about how he thinks people should be positioning, continues to resonate almost identically with the philosophy that you guys mentioned there at New Harbor. Mike, why don't we start with you? What was some of your reaction to what David said?
We love listening to David Stockman. I mean, he definitely sings our tune, and he calls out the Fed and other central banks for, what is rightfully their fault, for inflating asset prices, for falsifying the financial system, and creating a system that it's not based in reality or actual fundamental data. It's gone on way too long, and we spend most of our time calling out the Fed and central banks for what they've done. And if you just look at the data, whether it's stock market capitalization divided by GDP, which is at 202%, a new high, or a cyclically adjusted price earnings ratio, or John Hussman's margin, corporate profit margin adjusted cyclically price earnings ratio, every single one of them is at all-time highs by far. If you measure those indicators against, or if you plot them against what subsequent returns have been in the past, we're looking at solid of negative returns from these levels, something in the order of maybe -4, -5% a year over the next decade. I think that the Boston firm GMO, the firm that Jeremy Grantham at least part founded, Okay, the 7-year forecast just came out showing -7%, I think, annually for S&P 500 or large cap stocks over the next 7 years. So a lot of different disciplines are agreeing that we're beyond all reality. And you heard David there, not mince words, that we're from another planet. I just wrote down some of these things. He said we're absolutely from another planet. We've spent $6 trillion in the last year. And that was just after coronavirus to basically pump up the economy and, frankly, the stock market. In comparison, we spent $4 trillion inflation adjusted during World War II to come out of that. So we can go on, but love listening to David. We are single-handedly at one of the riskiest times, I think, in history, if not the riskiest time in history. And John and I can tell you from the dozens, maybe even hundreds of conversations we've had in the recent weeks, the general population is in a way losing their mind. Most people have some sort of fear of missing out. They're psychologically stressed. They want in. They're seeing bubbles go on, never ending. Almost every conversation has in it this question. Yes, I hear what you're saying and I agree with you, but how do you know this can't go on forever? So everyone sees it now, and yet very few people want to act, to take defensive action. The absolute definition of a bubble. So yeah, take defensive action. Listen to what David Stockman has to say. We don't know the timing, but get your ducks in a row.
Very well said, Mike. I'll hand the football to you here, John. I just want to note, Mike, you talk about a good chunk of the people kind of, almost losing their minds. It really is a great example of cognitive dissonance where, you've got some people that are seeing the party continue to go on. They're seeing the YOLO crowd and they're thinking, I'm not making as much money. Do I need to jump off the bench and get in, even if my gut's telling me otherwise? But I think you also have a lot of people who everything that David mentioned makes sense to them and they share that viewpoint, and they have the cognitive dissonance of rationally understanding that we are, as a nation, a country, as a financial system, way above our skis, and this is going to end badly. And yet they're still seeing us, the party train going on. And there's just got to be, I think, a really tough stress that most people are dealing with, which is, I know with every fiber of my rational mind, this is not going to last. But every day I wake up and continue to see it makes me think I'm taking crazy pills. So anyways, John, what do you have to say?
Add, it was a very good synopsis. We're big fans of David. He's a real Renaissance man in a way, and he even though you might attach him to a historically Republican political leaning, he is very willing and does amply dish out criticisms of both main political parties for the kind of policies that have driven us to the situation we're here today talking about. But I want to comment. So yeah, I've had plenty of conversations as well with folks who are tortured, and I say this with all compassion. And these are, people. We're all human, right? And we work really hard as investment advisors to tether ourselves and ground ourselves in the data, which can really help take the edge off an otherwise absolutely torturous kind of bubble type of dynamic going on. But because those conversations are very memorable in our heads, I think we sometimes forget we're having tons of conversations with very clear thinking folks who are actually quite content to step aside because they see the data, or they hear the data, or they see the perspective that we're putting in front of them, and they realize that, hey, this is really kind of insane. Even a pretty couple pretty basic charts can help even the average layperson see that this just doesn't look right, especially when you go back and look at a history of data that goes back a century or more in some cases. It doesn't take a PhD economist to look at those kinds of charts and say, hey, this just doesn't look right, because it doesn't. We are in absolute nosebleed territory in so many measures. But we're having also plenty of conversations with new clients, new prospective clients that they want to stand aside, and they know they don't have the ability to gamble their financial security because they don't get another do-over. Our clients are generally hardworking folks who have worked hard to save a nest egg, and that's really why we're here, to help folks like that to navigate and think clearly about their financial situation.
Well, and thank God that you guys do, because as we've all said, including David, it is such a hard and treacherous time right now for investors, both with the cross current of narratives, but also, there are people who, they need their money to grow. They need to invest to have more in the future. And yet, if they're talking to kind of the average broker out there, they're sort of cheering on the YOLO mindset. So to have people like you who can say, no, you've got very good reasons to be skeptical, to be defensive, and there are ways to keep your capital safe and yet put some of it to work for you in a way that is risk managed and can be protected to the downside. I just think there's very few people out there doing what you guys do. If you're watching and interested in that, I'll tell you at the very end of this video how you can talk to these guys if you want to. But before we do, guys, I do want to talk briefly about something that last week Bill Fleckenstein mentioned, which was the precious metals mining sector. Because you guys are very defensive. I'll let you speak for yourselves, but I know you have a pretty hefty cash position, but one of the areas in which you are long is the precious metals sector. And I'm going to put up a chart here from Crescat Capital that's showing free cash flow for gold and silver miners. And you can see here that it's actually now really at historic highs. This industry has really sort of cleaned itself up, and also the precious metals, have done pretty well over the past year. And these companies are really being able to kick off substantial amounts of cash. And why that's interesting and important right now is, as Bill Fleckenstein said last week, these companies are still trading, unlike almost the rest of the market, as David said. They're trading at like 1980s valuations, is what Bill said. So, Dave was talking about the Russell 2000 on average trading around 43 at a 43 price to earnings ratio. A lot of miners out there are trading at like a 6 to 8 price to earnings ratio. I mean, they are just heavily discounted relative to the market in general right now. And yes, there might be, they might go down if the market goes down in the future, but at those valuations, they are highly likely to correct an awful lot less than the rest of the market. And as Bill said, all of the the tailwinds that we're seeing happen right now that are driving the big trends going forward, one of them being higher inflation, that sector is likely going to be benefiting disproportionately from those trends going forward. So I just wanted to highlight that the miners look good. If you look at the price of gold and silver right now, it's actually seemed to have bottomed out in late March. Gold's up $100 an ounce since then. Silver's up 10%. So Mike, why don't we let you take this? But what are your thoughts on those comments based upon your current position in the miners?
Yeah, we agree with they're undervalued. They were undervalued a year ago. They're undervalued now. There was a kind of a painful correction from August to the recent low a couple weeks ago in both gold and in miners. We were watching gold for a long time to break that support shelf at 1765. We thought if it did, it would quickly go down to 1680 to 1720 or so. It did. We thought that's a good place to add. We still think it's a good place to add here. We could even go down one more time to test those levels, but we're in the right ballpark. I wouldn't try to game it too much. For people that don't have any gold or silver, any precious metals, add some gold here. And we're kind of agnostic a little bit with gold versus silver. Gold silver ratios come back in line. I personally think that gold is maybe a safer buy here right now. And in extension of that is the mining shares look very attractive here. We have a core position in miners. We continue to adjust our hedges. We presently have pretty good put protection on our miners, maybe 15 or 20% below current levels going out a couple months. That sounds like a big deductible, 15%, but what we're really trying to do is protect against a waterfall decline. The S&P, is the S&P 500, the broad market is in potential crash-like risk conditions all the time, and we can't discount or neglect our duty to protect against some kind of quick flush like that. So we keep some belt and suspenders on, but long term, we really like it and we think it's going a lot higher. So yeah, we would agree, and we want to keep that position.
Great, well said. And I just want to quickly highlight, there is a grassroots campaign going out across the internet right now for a Silver Squeeze #2 coming on May 1st, where they're trying to get 100,000 people to purchase 100 ounces of silver on that day. It's a 10-year anniversary of the largest silver smash in history. And who knows if they're going to be successful or not. I'm not saying it is or it isn't, but we might see some interesting price action in just a couple of, about a week and a half away. And whatever happens there, we'll be tracking it and reporting it here on this program. John, I'm going to give you the last word here this week.
I honestly don't have much to add. I think this was, David did a great job covering a lot of ground. I think it kind of stands on its own. We remained observant, vigilant, and patient and disciplined. That's kind of what we and many legendary investors have practiced over episodes like this, and that's what our instincts tell us to do as well.
All right, great. Well, look, if you are watching this and interested in preserving your wealth against the risk that David Stockman was mentioning there at the end of his part, our consistent guidance is look, we think this market is such that to be able to be a good steward of your wealth, you should be working under the instruction of a financial advisor who at least is aware of the type of risks and market conditions that David was talking about, can answer any questions you have about that, and then create a portfolio strategy for you based upon that, plus your own goals and your risk tolerance. If you've already got a good one, great. Stick with them. They literally are worth their weight in gold. If you don't, consider talking to John and Mike and their team at New Harbor. And if you've talked to them, but it's been a while, maybe it's time to do so again now. It's free. There's no strings attached, no obligation to work for them. If you want to learn how to do that, just stick around to the end of this video. We tell you how to do that. It takes only about 15 to 20 seconds to schedule an interview with them. And as we finish up here this week, folks, if you haven't yet already, please hit that subscribe button. It really does make a difference for us. While you're down there, click the like button too. If you want to know who we're going to be bringing on the program in the future, just follow me on Twitter at Menlo Bear. And with that, John and Mike, whatever happens next, you and I will be tracking it here on this program. See you guys next week.
We'll see you, Adam. Thanks.
We'll see you next week, Adam. Thank you.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.